You ever crack open a company's annual report and just your eyes glaze over? It feels like you're trying to read a totally different language. Well, you kind of are. Financial accounting is the language of business, and today we're going to learn how to speak it by translating two of its most important words, assets and liabilities.
So, what's with all the complexity? I mean, are they trying to be confusing? Not really. The thing is, business is messy. It's constantly changing. And these reports, they're the best attempt we have at capturing that complicated reality to paint an accurate financial picture, no matter how complex it gets.
To really get why these rules are so critical, we have to rewind the clock a little. Before we had these common standards, financial reporting was, well, it was the Wild West. Every company was telling its story in its own way. And you can imagine, that made it basically impossible to trust what you were reading, let alone compare one company to another. And these were the problems that really forced everyone's hand. See, financial tools were getting more and more complex, but the old accounting rules just couldn't keep up. This meant companies could hide massive losses from things like derivatives. And get this, they could also do something called profit smoothing. Say you had an amazing quarter. You could actually hide some of that profit and save it for a bad quarter, just to make your company look more stable than it really was. That's a huge risk for investors, right? So everyone started demanding one single, reliable set of rules. So here's how we're going to break it all down. We'll start with why these rules exist, then we'll explain assets versus liabilities, get into how you account for what you owe and what you own, touch on some weird hybrids, and then pull it all together with the big picture. Let's do it. All right, so with that history in mind, let's get down to the absolute basics, the foundational building blocks of any financial statement. Assets versus liabilities. It really does all start here. And the thing that creates them is called a financial instrument. Don't let the fancy name fool you. At its heart, it's just a contract. It's the loan agreement, the IOU on a napkin, the share certificate. It's the piece of paper that creates a financial link between two people or companies. So on one side of that contract, you've got a financial asset. And here are the magic words: a contractual right to receive cash. Simple as that. If a customer owes you money, that's an asset. You have a right to get paid. And on the other side, you have a financial liability. It's the perfect mirror image, a contractual obligation to deliver cash. So if you've taken out a loan from the bank, that's a liability. You have an obligation to pay them back. So let's just put it side by side. It all comes down to the direction the money is flowing. An asset means cash is supposed to come to you. A liability means cash is supposed to go away from you. That's really the core of it. And this visual just nails it. See the financial instrument right there in the middle? It's like the blueprint. It's the origin point that generates all the assets, liabilities, debt, and equity that make up a company's entire financial story. Okay, we've got the definitions down, but how do you actually track these things over time? Let's start with liabilities, what a company owes. And we'll use a good old-fashioned bank loan as our example. Think about it, a loan isn't just one number that sits there, right? Interest gets added on and payments get made. To keep track of this moving target, accountants use a method called amortized cost. It's basically how they tell the story of that loan year by year over its entire life. And this table here shows that story in action. You don't need to memorize the numbers, just see the pattern. Every year, you take the starting balance, you add the interest, you subtract the payment you made, and that gives you the new closing balance. It's just a running tally, but it's crucial for showing what a company truly owes at any given moment. So let's flip the coin. What about the other side? How do we account for financial assets, the things a company owns, like an investment in another company's bonds or shares? Now, this is where it gets really interesting. The accounting treatment isn't one size fits all. It actually changes based on what the company plans to do with that asset. It's all about reflecting reality. And to figure that out, you just have to ask two simple questions. It's like a little decision tree. First up, the business model test. This just asks, why do you own this thing? Is your plan to just sit back and collect the regular payments? Or are you planning to sell it for a quick buck? Then you've got the contractual cash flow test. This asks, what kind of payments does this thing make? Is it just simple principal and interest, like a basic loan? How a company answers those two questions determines the entire accounting story for that asset. All right, now we're getting to the really mind-bending stuff. What happens when a single thing looks like both a liability and equity? When that clear line between what you owe and what you own gets, well, blurry? So here's the puzzle for you. Imagine a company issues a bond. It pays interest, just like a normal loan, but it also gives the owner the option to trade that bond in for company shares later on. So what is it? Is it debt or is it equity? What do you do when it can be both?
Well, the accountants have a name for this kind of puzzle. They call it a compound instrument. And that convertible bond is the textbook example because it's got a little bit of loan DNA and a little bit of potential ownership DNA. It's a true hybrid. So, how on earth do they solve this? Well, the answer is actually pretty elegant. They don't try to force it into one box, they just split it. They break it down into its two fundamental parts. First, you've got the liability element. That's the company's basic promise to pay interest and give the money back if the owner doesn't convert. Then you've got the equity element, and that represents the value of the option to convert, that valuable right the owner has to become a shareholder one day. By doing this, the financial statements tell the whole story, accounting for both possible futures. Pretty clever, right?
So, okay, we've gone through definitions, tests, even the split accounting trick. But let's zoom out. Why do we go through all this trouble? What's the big picture here? At the end of the day, every single one of these rules is working towards one simple goal: transparency. It's about creating a common language, a shared framework that turns a bunch of numbers into a story you can actually trust. It's what allows an investor to look at company A and company B and make a fair apples-to-apples comparison. Look, these standards aren't just for number crunchers in a back room. They're for anyone who wants to really understand how a business works. So the next time you look at a balance sheet and you see financial liabilities or convertible bonds, you'll know there's a whole story there. You'll be able to look past the numbers and ask the most important question of all: what are they really trying to tell me?